your company's been around a long time. You know, you've navigated difficult times, you know, and clearly, you know, world wars, financial crisis more recently, but tech boom and bust, a lot of difficult times. What has helped you achieve this? James?
One of the most helpful things, I think, for Scottish American, for Saints, has been the revenue reserve, the ability to save some of the income we've earned in previous years, so that when we have extreme times and when there's extreme pressure on companies, we can supplement the income received from the investments we make, if necessary, from the reserves. And that helps smooth the income, and that's one reason, again, why you see that long record of dividend payments from Saints. I think the other thing that helps is probably the board of the company as well, that it challenges us as managers to make sure that we're keeping on the right path, that we're focused on those outcomes of the dependability of the income, the growth over time. And in times of stress or times of difficult financial market dislocations, they've been very helpful in keeping us focused on what we need to do to be able to extend that record with Saints.
Yes, you've just highlighted two real benefits of the investment company structure.
Yes, that's right,
there.
yeah.
Ben, how have you achieved a successful outcome during navigating difficult times?
Well, I think I very much echo what James has just said there. I think that the sort of 37 years without cutting a dividend for Digit, perhaps not quite as long as some trusts, but still a very respectable position to be in. And I think, again, that's been underpinned by revenue reserves. I think it's been underpinned by that strong independent board. Returns have been enhanced through the use of modest, conservatively deployed leverage. I think relatively modest fees compared to a lot of open-ended products all help to improve the overall return to investors. And I think it's also about knowing when the right time is to make strategic changes within the portfolio and within the structure of the company, that it's the right time to maybe look to issue long-term debt, to look more to credit, or potentially change the asset class within the company. Those are the kind of key decisions that ultimately can make big differences to investors over the long term.
Absolutely. I think the investment company sector is incredibly innovative and does make these changes when necessary. Paul, obviously you're the manager of the oldest investment company. Clearly, you know, you must have got through the tough times. What's helped you achieve that?
Well, I think the capital structure certainly is hugely advantageous for investment companies, having that closed-ended structure, revenue reserves. That really helps in terms of being able to take a long-term view and to provision for the less good times in terms of dividends. But I think the key really is innovation through time. One needs to adapt and change through time. And I think all of us here, the investment companies which we manage have evolved and changed to ensure that they're fit for purpose. So starting off as an emerging market debt fund 150 years ago, then investing into equities in the 1920s, and today a global growth fund, one-stop shop for investors. So adapting and changing to the times, I think, is the single most important lesson, along with diversification. A diversified approach to ensure that your portfolio is robust to withstand the stresses which inevitably will come along from time to time.